Hey everyone, thanks for joining with me. I'm really excited about this interview because it's something you all asked for, and that was, get Bob Langworthy back on this interview, and let's talk about seller financing. So right at the beginning of the year, Bob was gracious enough to give us some time. How you doing this morning, Bob?
I'm doing well, Michael. Thanks for having me back.
Oh, excellent. Your video got a lot of questions and comments, so I knew it's something we had to do. So we're actually going to break it into two parts. We're going to do, how does somebody go and talk to a seller? How do they find them? How do they have those discussions? And then in a subsequent video, maybe in the next week or so, we'll do the other side, why it's good for the buyer. So for this video, Bob, we're going to talk about talking to a seller and why is it good for a seller. Make sense?
That sounds great.
Yeah, and I think the first thing we need to do is just call out that owner finance deals aren't, they're not everywhere, right? There's only certain situations where it really makes sense to offer it. So I thought we'd just have a conversation, at least for a few minutes, about what does a right prospect look like to have a discussion. I thought I'd give it to you first to sort of highlight that. What do you think a right prospect is, even to approach the seller financing subject?
Sure, that's a great question. So there are sellers that they just want their money because they're looking to buy another house, buy another property, and they need the full amount, and they can't wait on the seller financing arrangement, which could be payments over any period of time, 10, 15, 20, 30 years. So what I see with clients that are in these arrangements, it's often a seller who's 50 years old or older, someone who's interested in regular monthly income. That's appealing to them, to have cash flow they can count on. Maybe they don't need the big lump sum. They're in a house that they like, or they're looking just to get out of investment real estate altogether. So that's one thing that I often see. Also, it's going to be someone who's owned the property for a while, maybe 10 years or longer. In that case, they've taken quite a bit of depreciation and the property has appreciated. So they're looking at a sizable gain potentially. And it's that gain wherein lies the opportunity for both the seller and the buyer.
Yeah. What do you think about, also adding to that, a seller, you said we've owned it for a long time, but what do you think about having any debt on it? Small debt, no debt. How do you feel about a seller, if they have a property that's, 60% LTV? Do you think they qualify as an option?
Yeah, so it brings up a number of potential issues kind of on both sides, right? So for the seller, if they've got, if their LTV is 80, 90%, then an owner finance arrangement is probably not going to work out for them.
Yeah.
But if it's a much lower LTV, or they own it outright, if they've owned the property for 20, 30 years and they own it free and clear, then they're a prime candidate for a situation like this.
Yeah, I bring that up because, I've run into situations where you find a seller that's owned it for 20 or 30 years and your natural assumption is they don't owe anything, right? Because, that's
Right.
what you do, right? You pay off properties. But we know that at least back when I was doing a lot of these in sort of 07, 08, properties were ATMs. And it was really a bad assumption to assume that somebody had owned it for 20 or 30 years had no debt, let alone low LTV. So, if they have high LTV, I would personally say anything over 50%, it's probably unlikely. So don't fish there, look elsewhere. So I agree with Bob. They're typically going to be older. They've typically owned it a long time. And let's call it LTV, loan to value ratio, not to throw acronyms at you, below 30% and preferably zero, frankly.
Right.
That kind of feels like the right discussion. Anything else, do they have to be local? Can they be anywhere? Right? Do you have to meet them? What other things do you think about when you're just talking to a seller?
Sure. So the location question is really up to the appetite and the risk tolerance of the buyer. If the buyer is looking to buy something out of state or not in their local area, then sure, that's owner financing is not at all something that would limit that as a possibility. Yeah. Preferably you meet them and you work with them. You may have a broker involved. You may not have a broker involved, depending on how you do it. So you're going to want to meet them. You're still going to want to do all of your regular due diligence. You're still going to want to have, an attorney or a title company draft up the paperwork for you so that that's rock solid. So you're still going to want to do all those items. You want to handle it professionally, arm's length, all of that. But location, you can do it anywhere.
Yeah, I totally agree with that with one slight tweak. When I think location, I think asset first, as you did, which is dead on. Location of the asset doesn't make, really much difference as long as it meets your buying criteria and whatever you're trying to do. That said, the other side of real estate, because it is such a people business, as we both talk about, is you've got to meet the seller, right? If you're the buyer, and frankly, the seller should demand to meet you, frankly, because you're essentially establishing a decade or 2 or 3 relationship. And, I certainly would want to meet anybody that I'm going to be in a relationship for 10 years. Would you agree?
That's right. Absolutely. Yeah.
Yeah. All right. So now I think we got a nice painting of a right prospect. They've owned it a while. Let's say they own 0. But now you find somebody like that. How do you qualify them? Right. So, okay, you've got 100 prospects out of 1,000 properties, just using rough numbers. How do you go and start to sort of, qualify or filter that list of 100 down to the ones that are likely? And any thoughts on key questions or anything like that, Bob?
Sure. So the person who's interested in selling using this type of arrangement is going to be interested in the possibility of payments over time. That's really the big question for them. Do they need the money now, or would they like a regular monthly income stream? And when we get into the math, we'll see that one of the big advantages for the seller is they can get more money for the property than they're asking. And so that may be a way to phrase the question. Suppose it's a property that's a $400,000 property it's on the market for, and do they want $400,000 now, or would they rather have $450,000 over time?
Right. Yeah, I think the big question for me is kind of a softball, and that is, what's your plan for the money? Mm-hmm. Another one, depending on how the relationship is going, is, wow, you're going to have a huge tax bill, right? I think you sort of come at it from 2 ways. I think the softball one is, just curious, you've been in real estate for a long time, you've owned this asset, I'm just starting, blah, blah, blah. I'm curious, what does somebody do when they cash out, right? They may be, oh, I'm going to go on a worldwide cruise that I've been planning forever, and like they're locked in, or it's, I'm going to put in a money market account, I have no idea what I'm doing with it, right? So there's
good questions.
Yeah. So these are the things that you need to figure out what they're doing, right? And if the answer is something like, I've got to pay for my wife's dialysis or husband's, whatever it is, right? Then that's, you sort of cross them off the list, right? They need the cash, right? Cash is more important than anything. So that's what I think about when I talk to sellers. Go ahead.
One other thought on this: there are some asset classes which are more likely to do owner financing, and an example is land.
Ah, yes.
You can't get a loan to purchase land from any institution that I know. So an owner finance arrangement often works out well with the purchase of land.
Excellent point. I had not thought of that. That's very true. Be careful though. Land doesn't produce income, but yes,
exactly. Yeah.
And hence you don't get loans on them. So, but absolutely right. We just did an interview yesterday with I think it was JJ, and he started buying land. So he paid cash, I think $7,000 a lot. He could have done an owner finance deal and sort of cashed him out after he built his duplex. So that's a great point. Land is something to look for owner financing on. So now we've sort of qualified them. They're right. I think the biggest question I get from people is, how can I get the seller to understand it's good for them? Yeah. And when I hear this question, I go, I'm going to ask Bob how he would have that discussion, and I'm going to shut up and just listen. So how do you do that, Bob?
Well, that's a great question, and it's the right question. And it takes that relationship with the seller that you talked about that's so important. And the math ends up being fairly simple. So, the hypothetical that I've got, and you can see some of the numbers on the board, I'll kind of talk through it, is for a fourplex that was purchased in 1989 for $100,000. They put $50,000 into it. So they've got $150,000 into it, but they bought it in 1989. So they've got $115,000 in depreciation. Their basis is all the way down to $35,000. And now it's 2019, and that property is worth $400,000. Now they're looking at potentially a $365,000 gain on that property. And that's a big tax hit. And there's long-term capital gains that everybody's aware of, but you also have to recapture the depreciation. There's a tax on that. It's taxed at your ordinary income rates. That is often overlooked in these calculations. And then in my hypothetical, this person also has $100,000 of regular income. So now with this $365,000 gain, they're subject to the net investment income tax of 3.8%. So when I run the numbers on that, their $400,000, they're going to owe $71,000 in taxes on that. So they're only going to receive $329,000 effectively for the sale of this property. And that's with traditional financing. I go to the bank, I get a loan for $400,000, and they get that check. They're left at the end of the day with $329,000. So that's kind of data point one. $329,000 is what you get.
Yeah. So let me break that down from the non-accountant, or at least the non-CPA, because I actually have an accounting degree of all things, but I'm not a CPA. So let's rewind the clock and correct me if I get anything this wrong. So 1989, this lovely couple goes out and buys their fourplex for $100,000, and they put 50 in. So they're into the property for 150, right? So that's their basis, which then gets depreciated over time. Fourplexes are residential, so it's 28 and a half years. Is that right?
Yeah, 27 and a half.
Oh, 27 and a half years. Okay.
Yep.
So now we fast forward 29 years. They have had 29 years of this, phantom cost or expense, right? That shields income, which is another great advantage to have real estate. So it's awesome. But now what they've done is they've taken $115,000 of that, and their now basis, at least from the IRS perspective, is $35,000.
And that's essentially, for my example, that's the land, because you can't depreciate land.
Perfect. Excellent. Yeah, that's right. You can't depreciate land. So now they're 29 or 30 years older. They're looking to get out. They put it on the market for $400,000, and they get a buyer. They think they're going to walk away with something close to, I don't know what they think. Most people that I talk to think they're going to walk away with, $250,000 profit, because I think most people agree with that, right? This is the naive person.
That's right.
I bought it for 100, put 50 in. I'm in it for 150. I sell it for 400. I owe taxes on 250. That's what most people think. And that's wrong. That's the first thing to highlight potentially for sellers is to highlight that, I guess, error in judgment or misunderstanding, because the IRS wants their money back, right? They've basically given you an interest-free loan, if you will, for 29 years, and like, time to pay up, right? So that's the depreciation recapture that I know most people miss. And I actually didn't know it's taxed at ordinary income, but that makes perfect sense. And most people's ordinary income is higher than the capital gains tax, at least most people.
Most.
Yeah, most. So in your example, long-term capital gains was 15%, which they probably planned for, but they're also going to do depreciation recapture tax, which is actually larger than the capital gains tax.
Right.
So
that's right. Yep.
That's a big deal, people. That you need to educate them on that. Because the IRS is willing to give you these depreciation, every year, but they're going to want it back, right? And if they just sell for cash, the IRS is going to get it back in one big chunk, and most sellers don't know that, and they are surprised when they file their taxes. And then the other smaller tax I did not know about either. What was that again? NIIT?
That's correct. It's the net investment income tax, and that came about as part of the Affordable Care Act. It's 3.8% on higher incomes.
There you go. That include investment. So if you make, another reason to do a owner finance deal, so you can actually eliminate that altogether, because you can spread out payments. So what I want us to sort of think about this first analogy is, a seller who's selling this fourplex for $400,000. We're gonna try to see if this analogy holds. We're gonna treat that like a big loaf of bread. And if they sell it for cash or a loan or whatever, basically a bank financing, they're going to get the entire loaf of bread in one chunk. And they're going to have to whack off, I don't know, almost 20% of the bread for taxes. I think it's 18%. well, whatever, let's call it 20%. They're going to give 20% of that bread array to the IRS, and they're going to keep the rest. That's not very cool and not very sexy. So, Bob, why don't you talk to us how they could go in and via a different kind of financing, i.e. owner financing, get more of the bread and control how the slices are done.
Sure. So in my hypothetical here, I said, well, what if instead of that buyer getting a mortgage for $400,000 from a bank, what if the seller finances it and the buyer puts down 10%? Because you can do whatever you want with owner financing.
Yep.
So they put down 10%, and then the seller holds the note on the $360,000. And buyer and seller go back and forth, and the seller's more concerned about the number of years. The buyer's more concerned about the interest rate, but they agree on a 25-year term and 3%, because that works out for both of them. Mm-hmm. So if you do that math, that's a monthly payment of $1,700, or annually it's just over $20,000. It's $20,500 a year that seller would get. So simple math, $20,500 that seller is going to get for 25 years, plus the $40,000 down payment. That's $550,000 now that this seller gets by doing seller finance. Now they have to be patient. They have to be willing to wait the 25 years. But that's a substantial amount of money, more than what they had been asking for, the $400,000. Now, the beauty of it is that this arrangement allows that income to be taxed on what we call the installment sale. So instead of all the income being taxed in the 1 year, as our original example is, now you're only taxed on the income as you receive it. So in any year where they're receiving $20,000 of payments from the buyer, well, now they only have a small $3,200 in tax. And when you do all the math, what is that tax over the 25 years, and you take your $550 that they would have received and you back out the tax, the seller ends up at the end of the day with $471,000 after tax. Now that's an increase of $142,000 over the original example. I mean, it's tremendous for them if they're in that position where they can do this type of arrangement.
Yeah. So again, going back to the loaf of bread. So we're basically taking the first story, which was give it to me all now. I'm going to give 20% away to the government. Because you've qualified them and had the discussion, built the relationship, you're able to structure an installment sale. That's a word that you need to work in, because that's going to help you with the taxes, because you're going to be able to only tax the lender, in this case, the seller, is only going to be taxed on the proceeds they receive from the installment sale year after year after year. So you're basically able to control the income, which when I say that, you should also think taxes. And thus, by lowering your income, you lower your taxes. And then in addition, as Bob's highlighted for us correctly, you're also eliminating tax, buckets or types, i.e. the NIIT is gone, because you've kept your income below the right threshold. So, and then the cherry on top, the seller gets more cash. I think this is so awesome. So you can control the slices of bread. You actually get more bread, which is awesome. So did I summarize that fairly?
Absolutely. No, you did a fine job on that. Yeah, there's a lot of opportunity, a lot of wins in this for the seller.
So give us a little bit more color on the installment sale. I think that's one piece of vocabulary we dropped in here that maybe we didn't hit last time. Just define an installment sale quickly, and why that changes how taxes are done.
Yep. With an installment sale, you are dividing up the income from what you've sold over the period of time in which you're receiving that income. So with our example, instead of receiving $400,000 at once, you're receiving $20,000 a year for 25 years. Those are the installment payments, essentially, that the buyer is making to the seller. And then you're only taxed on income that you've actually received. So that's where that great reduction in tax can come in.
Yeah. And, again, simple guy here, right? So again, installment sale is think about it just like your income, right? The IRS will always want to be paid their fair share based on income you've made in a year. They're not asking you to prepay, right? They're not saying, hey, I want your 2019 and 2020 taxes now, even though you haven't earned the income. That's exactly what's happening in this sale of this fourplex, right? The seller has created an arrangement where they're going to receive partial payments for 25 years, and the IRS only wants the payments that was received in that calendar year. So it's the same example, just a different word, i.e. the installment sale. So let's step back and try to be, that newbie who's going out. So to summarize, we said, look for someone who's owned the property a while, ideally has low LTV, if not zero. Over 50 was something you brought up, Bob. Anything else to sort of bring it back to the beginning that is important to hit again?
I think those are, the highlights. And, I wonder if in this rising interest rate environment that we're in, if you'll see more owner finance arrangements as people look for a way to, avoid a high interest rate on a loan if you're on one side of the transaction, or to lock in a better interest rate if you're on the other side of the transaction. So a lot of opportunity. As we discussed in our kind of list of criteria, this isn't for everyone.
Right.
A lot of sellers aren't going to go this route because they need the money and whatever the other factors are. So this is going to be a smaller percentage of sellers that are interested in doing this. But for those sellers, there's a lot of opportunity.
No, I totally agree. And just another idea popped in of a deal I did actually last year. I had a seller who hit all the criteria, right? They were over 50. They'd owned it a while. They actually owned it for zero. But during our discussion, and they were interested in owner financing, but for whatever reason, they were stuck on a number, right? Like using your example, right? Where the market was 400, they wanted 450, right? And for whatever reason, I don't know if their neighbor or their brother, I mean, it was something, I never figured out why, but there was some reason he needed 450. So again, right, we're talking about doing a 30-year loan, and he was okay with that time frame. I just controlled the interest rate, right? I bought the interest rate under 2%. It's like, okay, fine. If I can give you your price, but you need my term, right?
Yeah.
Because I was only worried about the payment. So
that's a great example.
Yeah, lots of things you could do with owner financing. When you have the discussion, you find someone there, you meet them. You've got to meet them, people. Don't try to do this stuff over the phone. And then, the beauty of what you've laid out for us is again, most people think they're going to get the monthly income when they think owner financing. But what you've given the listeners watching this is you've given them the script to talk about a tax savings, which is huge, which I didn't do or didn't know about, which is awesome. And then you're actually highlighting, you know what? They're going to get more cash. So that should be a great conversation for people to have. So thank you very much.
Yeah, absolutely.
Yeah. So anything in closing you want to sort of highlight how people can get a hold of you again and hopefully build your Rolodex of investors and joining your firm?
Absolutely. Thank you, Michael. I'm active on Bigger Pockets at Bob Langworthy. You can find me there. And my company website is mainbeancounters.com. That's Maine like the state where I live, beancounters.com. And feel free to get a hold of me, and I'll gladly share this spreadsheet. People can play around with it, put their own numbers into it, and see what the opportunity looks like for the potential seller.
Excellent. And just one more thing, and investors can be from anywhere around the country. It's still strongly recommend reaching out to Bob and having him be your CPA, your accountant. He gets it. He speaks our language. And as you can see, he's very knowledgeable. So I appreciate your time this morning, Bob, and have a great day.
Very good, Michael. Thank you. You too.
All right. Take care.